Hello, everyone, and welcome to my YouTube channel. It is a great pleasure to have today my good friend Lance Roberts. He's Chief Strategist at RIA Advisors, and he's also the host of the Real Investment Show. Lance, how are you?
I'm fantastic. How are you?
Very good, very good. Can't complain. You know,
I
in
like
this
it.
booming markets, crazy
Exactly.
economy. What can we say? No.
It's all good.
I would like to start with a little bit of a summary from your side about how you see, number one, the economy. Number two, how you see markets and the current status of equities, bonds in general.
Okay, so I hope everybody brought lunch because this is going to take a while. No, it's a very interesting situation that we're in right now. Look, the markets are extremely optimistic about the future of the economy, and that's great. And I think it's very important to understand that, yes, a lot of the thesis that we're hearing right now is that we have, a vaccine, and at least in the U.S. It's struggling to get distributed in Europe, but in the US, we've got about 50% of the population vaccinated. And so that means people are going back to work, and we are seeing that. We're seeing miles driven come back up. I live in Houston, Texas. We have traffic; it's back. So we're seeing that activity. Restaurants are going, opening back up. People are going out to eat. They're going to movies. All those type of things. All good stuff. Nothing wrong with that. But there's a difference. When you talk to kind of the mainstream economists, they're saying, okay, this year is going to be great economic growth. We're going to have 6.5% annualized growth rate. That's the biggest growth rate in the economy since the 1990s. And that's absolutely correct. What they don't tell you is that next year in 2022, that economic growth rate is going to return back to norms, which will be around 2% growth overall. Now, prior in the 1990s, if we were near 2% economic growth, we would say that was near recession levels in an economy, because that's just a level to basically absorb population growth, really not much more than that. So now we have adopted this principle since 2000 that if we've got 2% growth, great. That's good news. We're growing, not much, but we're growing, right? So this is the reality, is that we're having an economic recovery, and that is far different than an economic expansion, which is what the markets are pricing in. The markets are pricing in the 6% economic growth is here to stay, and that's going to continue into the future. That's not the case. Stocks are, when we buy stocks, we base those on valuations, on earnings. Now, this is what a lot of people miss. Right now, earnings estimates are being ratcheted up across the board. It's expected that by the end of 2021, earnings per share for the S&P 500 on a reported basis, it will be $153 a share. Now, that's up sharply from the $94 a share at the end of 2020. Here's the problem. The markets are now 20% higher than they were back in 2020. And the estimate for the end of 2021 earnings in 2020 was $174 a share. So yes, earnings are recovering, but we're not even recovering back to what we thought the original estimates were. So we're grossly overpaying for the value of earnings that we've got now because of where markets are trading and where stocks are trading, and because of exuberance. And of course, this is all part of the stimulus and the drive to put money into markets. Nothing wrong with any of that. Just understand that there's going to be a payback when earnings fail to achieve the valuations reduction because of increased earnings in the future. And that's the risk, and that's the game that investors are playing and not really aware of.
One of the things that in the prior years, when we saw this multiple expansion, the bullish theory was, yes, it is true that multiples are expanding, but if you compare that to where government bond yields are, then stocks are not that expensive, because government bond yields at negative real or nominal levels basically mean that stocks remain relatively cheap against bonds, which is correct. Right. Now, the problem now is that bond yields are creeping up, and that inflation is coming back. So I said the other day that one of the things that I find interesting is that for once, what I'm hearing in the message from consensus is a market that is betting on one thing and the opposite at the same time. On
Right.
one side, return to growth, phenomenal recovery, fantastic inflation because it's not too high, but it's not too low, whilst at the same time, extremely negative real yields and very low interest rates. How can we reconcile those two things?
Well, it's interesting. Two things. I'm going to argue with you a little bit because that's what makes a good, podcast, and also do a little bit of comparison here. So, first of all, let's talk about the level of interest rates. Now, interest rates have a very high correlation to economic growth and inflation over time. So, I mean, if we go back to 1940s and we track out inflation, the inflation growth rates, economic growth rates, interest growth rates, they all correlate very closely together, and not surprising. Because if economic growth is growing, you're going to get higher prices, higher wages. That's going to lead to inflationary pressures. And interest rates can come up because lenders can charge more for the inflation risk adjustment in the loans that they're making, whether it's corporate debt or personal loans or whatever it is. So it makes complete sense that interest rates and inflation and economic growth all track each other. Here's the interesting thing. Right now, we're talking about 6.5% economic growth for 2020. And let's not even talk about, 2021. Let's not even talk about 2022 yet. But bond yields are at 1.75%. They are lower today with the expectation of this booming economic growth than they were at the peak of the market in 2020 before the pandemic. So in other words, what yields are telling us, and I'm actually writing this in our newsletter for this weekend, the bond yields are telling us that economic growth won't be really as strong. It may be nominally strong, but on an inflation adjusted basis and on a real basis, in other words, are we putting people back to work? Are we creating wage growth? Those type of things. That may not actually turn out to be the case. And it's also suggesting that forward growth rates on the economy are going to return very quickly back to around 2% growth longer term over the next couple of years. Now, I said I was going to argue with you.
No, I completely agree.
I know, but I'm going to agree. I'm going to disagree with you on one thing. No, actually, I'm not going to disagree with you, but I want to point out something. The premise you made, which is you're absolutely correct. The premise has been that low interest rates justify high valuations.
Sure.
If you run a correlation between interest rates and valuations on stock, there is an almost zero correlation between those. In fact, there's only been one other point in history where there's been high valuations and low rates, and that was just prior to the 1929 crash in the markets. There is no long-term correlation that suggests that low interest rates justify high valuations. And the misnomer of the statement is that people are discounting the P in valuations, the price, but you also must discount the E in the price because low interest rates suggest that you have low, weak economic growth and lower rates of earnings growth. And that's a big misnomer that's put out in the market to justify that bullish thesis.
One of the things that I find very interesting is that as an economist, I'm seeing the most out of this world fiscal multiplier expectations of the stimulus. I've never seen anything like this. I've seen very optimistic Keynesian estimates of 1.1 times, but I've never seen expectations of 2.3 in open and highly indebted economies. I'm seeing that the IMF is expecting a 12% growth for the United States economy in the next couple of years. The European, the Eurozone economy, which has not delivered any multiplier effect from not one, but 3 consecutive stimulus plans, is expected to have one of the largest multiplier effects. So this expectation, I agree that the point is 2021, absolutely. Obviously, you're going to have this sugar high impact. The problem after the sugar high is the sugar low, is that
the crash.
is that you have 2022, in which the diminishing effect of these of these stimuli,
Right.
one after the other, is likely to be, it's impossible to achieve that level of growth. And
Right.
and you pointed out earnings, because the other part of the equation is inflation, isn't it?
Right.
We're seeing that inflation is coming back. Producer price indices are going up. However, it does not seem like businesses are able to pass those increases to consumers, and then margins are affected.
Right.
Do you see
Right.
that risk?
Yeah, absolutely. We're going to see it on two fronts. One, we're going to see it on export prices, which for the U.S. companies in particular, roughly about 40% of the earnings, corporate profits of U.S. companies come from exports. Export prices are surging right now, so that means that, unfortunately, when I ship a product to you, you're going to pay more for it. And particularly, one thing that we expect to see later this year is a strengthening dollar. If the economy is indeed going to be strong, and if people think the economy is strengthening, that's going to attract inflows into the US dollar, because we have a stronger economy than, say, the Eurozone. That's going to attract investment and attract reserves in the US economy. That's a stronger dollar. That also is going to impact what we deliver in terms of you being able to buy goods from the US. That cost goes up. So inflation on your side, absolutely. On our side, we're already seeing higher import prices. Commodity prices are going up, et cetera. And this is the misnomer about stimulus, which and particularly universal basic income, which is kind of the Democrats' wish list right now, is that we can just start giving everybody $1,000 a month or whatever it is. The problem is that when you give people more money, companies know they just got more money. We just know that March was going to be huge in terms of retail sales because of the $1,400 stimulus. Everybody knew that was coming. They didn't go out and hire a bunch of new people. They didn't go do a lot of capex spending. They didn't build up inventories because they knew it was a one-time shot. That's creating price pressures. Now, Coca-Cola, Procter & Gamble, basically these consumer goods companies have all announced just in recent earnings periods that they're going to start passing along these higher prices to individuals. So great, we just gave them money. We're going to lift them out of poverty for 1 year. We're going to hit them with higher prices. And as soon as their stimulus goes away, now they've got higher prices and no wage growth. They're right back in the same problem they were before, which is going to be a drag on economic growth. The problem with all of these stimulus programs, and let's go back to what you just said a second ago, yes, we're going to have 6.5%, 7% economic growth this year, but that's not organic expansion. It is a non-organic recovery back to where we were previously before we shut down the economy. And that was an artificially induced recession because we shut down activity, right? So all we're doing is just getting back to where we were. That's not growth. That's just a recovery, and that's not sustainable. So the multipliers that you're talking about, here's a real simple question that nobody's been able to answer for me. And you're a great economist, and I love you for what you do. But if the economic growth is going to be 6, 7, 8, 9%, whatever you want it to be in the US this year, why is the monetary velocity dead in the water? It's not moving at all. There is no impetus between what's happening with the stimulus and actual economic growth and velocity of money in the system.
Absolutely. That is a key factor for people to understand the very poor translation of stimulus to real long-term economic growth and potential growth. Because what is happening is that when we look at money velocity, is showing the real translation of money into economic activity. A lot of people in the Keynesian side will tell you, well, that's a bad calculation because you need to add to that the deficit of the government. If you add to that, then money velocity is very high. But that is spent on current spending. And it's spent by doing what? By massively increasing debt. So it's not real money velocity. And so one of the things that shows that they're trying to basically recreate the message is that as long as all of that money goes to government, that there will be some form of impact on the real economy. But you can have, I always say to my students that the GDP is the only economic calculation in the world in which you put together what you earn with what you spend.
Right.
And obviously, if you spend a lot and you get highly indebted, GDP is going to go up. But in an open and already indebted economy, the next year, the hangover of the stimulus is brutal. Coming back to your point about money velocity, which is something that you mentioned, is that nobody is mentioning anymore in the mainstream economic arena, because they say that it's, there are different ways of calculating it, blah, 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 only to justify the simple reality that newly created money is not generating a multiplier, a real multiplier effect.
Right.
Which goes back to margins, because you were mentioning, you're going to have pricing pressure, earnings growth way below the increase in the economic activity from the, aggregate GDP, but the impact on consumers is much larger than what people are actually estimating. So what do you think about this concept of the savings glut that is going to become this massive wave of consumption in 2022 to offset the government stimuli?
So here's an interesting thing, right? One of the arguments that has been made, both for the stock market as well as for the economy, is this massive amount of cash that's sitting on the sidelines right now. There's trillions of dollars sitting in cash. I want to talk about this from two different aspects, first of all. So let's start with the economy, this cash on the sidelines. This is a real illusion that is created in the economy because of the what we call the wealth gap disparity in the US. And I've run charts on this before. I've done some analysis on this as well. But you have at the top end of the income spectrum, you have the top 10% of income earners. We shut down the economy last year. They had income. They were not affected. They're business owners. They are wealthy individuals, et cetera. We shut down the economy. They couldn't spend money. So they accumulated savings during that period of time. Yes, we gave money in terms of stimulus to the lower 80%, but those individuals were already living paycheck to paycheck. They had no buffer. So when that stimulus hit, they immediately spent it on trying to buy toilet paper or food or other goods and services that they needed just to sustain their standard of living. Maybe they accumulated a little bit of savings because they didn't have to pay rent, but that moratorium on rent payments is coming due here soon. They are going to have to make those rent payments or catch up or be kicked out of their house. So we've seen at the lower end, we saw people that didn't have to pay rent. They said, great, I'm accumulating some savings. They went and bought a house. They went and bought a car. We saw that activity. That pent-up demand for the bottom 80% is not really there. The individuals at the top 10% of income earners that accumulated a lot of savings over the last year, they've already been spending and basically they're not going to go out and buy another house. They're not going to go buy 4 more cars. They're not going to buy another jet. They've just accumulated excess savings. And yeah, they may spend some of that, but that impact is not going to be this massive flood back into the economy. So there's going to be a disappointment of this idea that there's all these trillions of dollars in cash. And more importantly, a lot of that cash, a vast majority of that cash on the sidelines belonged to corporations. Yeah. When we shut down the economy, they drew down credit lines, they issued debt. We have record corporate debt now. They sold equity. They did all kinds of stuff to raise cash and made sure that they had cash buffers to withstand the economic slowdown, which is exactly what you'd expect them to do. But now they have trillions of dollars of cash. So what are they doing with that cash? Well, just an interesting chart out today from the Wall Street Journal showing that capex expectations, capital expenditures, companies spending this cash to go build out new property, plant, equipment, hire employees, do those type of things to grow their business, build inventories, has fallen to a new low. In other words, there's no expectation of these companies to take that cash and spend it on capex. Why are they not spending cash on capex? They asked them the question. They said, well, we don't really see a need to do it. Well, hold on a second. If we've got 6.5% or 8% economic growth and that's going to be sustained, you should have all the need in the world to be expanding out capex, right? They don't see it because they understand that this stimulus is a temporary impact on economic growth. So what are they doing with their cash? Stock buybacks just hit an all-time record. Stock buybacks are not a benefit to shareholders. In fact, stock buybacks were legal until 1990 because it's a form of stock market manipulation. Stock buybacks are used by individuals to sell inside companies to sell their shares. on these stock buybacks. So because we have so much stock-based compensation for executives, they use the sales of their shares on these stock buybacks to enrich themselves. And that's why right now insider sales are at the highest level ever on record by almost double. Insiders are selling shares like crazy while retail investors are buying stocks. Somebody knows something's not right here. But this is the problem. And lastly, when it comes to the stock market, there is no stock on cash on the sidelines. The next time you hear somebody on the media say this, just slap somebody, because if there is a buyer in the market, somebody had to sell to them. It's like a football game, right? Or for you, it'd be a soccer game. If you take one player out, you've got to put one player in, right? It's always that case in the market. So there's always a buyer for every seller. So there is never cash on the sidelines. The only thing that moves prices up or down is simply where the buyer or the seller is willing to execute the transaction. Complete myth on that point. That's a myth in the markets we need to kill off pretty quickly.
I remember once that in an interview that somebody was saying, why are there so many sellers? And I said, well, every day there are as many sellers as buyers. It's just,
exactly.
And they were like, oh, okay. So they're selling it to somebody.
Yeah.
That brings us to another important point, which is the capex cycle.
Right.
The reason why most corporations are not aiming to increase their capital expenditure programs is fundamentally because we went from overcapacity in 2019 to more overcapacity in 2020 because of the bailout of everything. Is that there has been no cleanup of the excess capacity. Therefore, if any of the companies that have been doing rather well or even phenomenally in this environment could find for opportunities to make either acquisitions or look for capital expenditure plans, they found themselves with very little in terms of opportunity, and that most of the eligible takeout candidates have already been taken out because takeovers are also at all-time high, no?
Yeah, no, absolutely right. I mean, and look, we talked about valuations earlier, right? So, I mean, if you're a company and you're looking to take over an acquisition, right now you're expensively valued. So that would really make your stock a valuable commodity because you're way overvalued in terms of the value of your company. Use your stock to make an acquisition. The problem is, and this is the Warren Buffett problem and why Warren Buffett continues to sit on $170 billion of cash. What are you going to buy that's not overvalued, right? And so by keep bailing out these markets, and I wrote an article a while back talking about why recessions are actually a good thing and we should let them happen.
Yeah.
We stop letting these reversions happen. We keep stopping the process of the economy fixing itself. And so we keep these valuations extraordinarily high. So the value of buying another company really isn't there because you've got to overpay for it, which means that the return on your investment long-term from that acquisition isn't worth it.
Yeah. I was talking with a value investor the other day who was saying value investors today are looking at companies with no growth at 17 times earnings. Yeah. So that tells you everything, no? That's the value part of the spectrum. Think about the allegedly growth, no? What about the impact of this infrastructure plan that is so massively promoted everywhere as the next big thing, the $2 trillion infrastructure plan that the Biden administration is going to implement? Because the bullish argument is this is the first time in which you're going to have a stimulus that will actually have impact on productivity growth. What is your take on that? What do you think?
So, this has been compared to FDR back in the 1940s with the New Deal, right? And, the thing is that Dr. Alan Woody Brock, he was a economist here in the United States, wrote a great book called American Gridlock. And he's talked about specifically the process of using debt to finance productivity. And his issue is that if you take, say you have country A, and country A takes money in debt and builds a dam with it. And say the Hoover Dam in World War II, right? So
Yeah.
during the FDR, we built the Hoover Dam. That dam is still providing electricity today. People are still paying for the electricity that dam generates. That dam has repaid that debt multiple times over. That's a productive investment. I use debt to build an asset that created a long-term return that not only repaid the debt, but created a profit for the government. The problem is that when you look at this infrastructure plan, only 6% of it is actual infrastructure.
That's
The rest, the rest of it is all these kind of democratic wish list of stuff that do not create long-term returns. So great, we spent $5 trillion on stimulus in just the last year. We're running a $4 trillion deficit right now in the U.S. And now we're going to throw another couple of trillion on top of it. But hey, $1 trillion between friends, it's just change now, right? The problem is that debt has to be serviced long-term. The use of that money is a one-time benefit to the economy. It has no return on investment long-term. And even the problem is that when we look at the 6% of the program that is actual infrastructure, we're rebuilding some roads, some bridges, some waterways. Those don't create long-term returns. They create some short-term jobs to build them, but once I'm done with it, I don't have that repayment over time. So what should we be using infrastructure for? I'm all for an infrastructure plan. We should be doing it. We should be building hydroelectric dams. We should be building nuclear power plants. We should be, because we want to be green, right? We want to do all that. So let's build green facilities that actually create green energy long-term that will pay for themselves over time. Spend $1 trillion, rework the power grid, build nuclear power plants, build some hydroelectric dams, get rid of the windmills and the solar wind farms, which are non-productive, and create a lot of waste after the fact that you can't dispose of. And that's product and productivity that would work long term. But unfortunately, the way government spends money is always the same case. And this is why we keep getting further into debt and have lower rates of economic growth, is because all of the debt that we spend is for non-productive purposes. More than 100 cents of every tax dollar coming in terms of revenue is spent on welfare now. Welfare and interest on the debt. Outside of that, anything the government does requires more debt to do it.
Certainly, because that's one of the key risks as well, is that mandatory spending is going through the roof in the budget, and that it's as mandatory spending goes through the roof, the chronic deficit is larger. And not just that, but I heard the other day an economist saying, no, Daniel, the fact that it's not physical infrastructure doesn't mean that it is not infrastructure. And I said, what are you talking about? And he said, no, because there are other types of infrastructure, and you have implemented them in the Eurozone. And I said, yeah, you want to see the results? Because I'm happy to show them to you. I'm happy to show them to you. 8.3% unemployment, double the average, including the furloughed jobs, and stagnation. So that is a huge risk that I see in the U.S. economy. The U.S. economy,
Absolutely. I love this new term they have, human infrastructure.
Yeah,
right?
Exactly. Yeah.
So, that's just cover for socialism. And, look, I get in this argument quite often, and look, capitalism has a bad name right now, and because look, it's a function of what's happened with the Federal Reserve, and corporations have taken advantage of the system, and capitalism has a really bad name. But capitalism in the U.S. has created wealth head and shoulders above any other country in the world. And socialism, while it sounds great, and it's terrible that I see so many of our young kids in society today, wanting socialistic policies, because socialistic policies do work, except the fact that they work by bringing everybody to the lowest common denominator. Yes, everybody is equal. Yes, everybody has equality at the lowest possible level. And that's not what you're really wanting, for your life and for your economy long term. The opportunities evaporate for you to create wealth for yourself and health and prosperity. And you can look at every other country in the world that's tried it. They've had the same results. And I don't know why people keep thinking it's going to be different this time.
Well, because socialism is always compared with its best intentions, and capitalism is always compared with its worst results. That's a reality. And governments can only equalize down. That's something that people just don't understand. The other problem is that in the United States, that's the reason why I wrote Freedom or Equality, as you know, is in the United States, they say, oh, no, but I'm talking about the Nordic countries. The Nordic countries are not socialist. The Nordic countries are more capitalist, probably, than the United States in many cases. Look at the differences in how government spending is implemented relative to the power of government itself. Government has very limited powers in those countries, and they have their leaders in economic freedom and their leaders in ease of doing business. After such a massive amount of stimuli, and as after the process of recovery, jobless claims still around the 500,000, continuing jobless claims about 3.7, 3.6. What do you think is the long-term picture that we can expect? Because what I always say to people, but look at the labor participation rate. It's atrocious, 61%.
Yeah, and that's a couple things. Real quick before we jump off the Nordic countries for a moment, I think that's such an important point, and that's going to feed back into my answer to you, is that when people look at Nordic countries, go, yeah, that worked great over there. They've got a population of like 6 million people.
Yeah.
We've got 330 million people in the US.
Yeah.
It's vastly different. And it's easy with a very small population. You can do a lot of really cool things with government money, but 330 million people, vastly different. But yeah, the issue longer term, when we look at labor force participation rates, the economy, employment, these type of things, we could effectively have no unemployment in the US. And this is really, I think, what the Fed is going for. We have a consistent rate of people falling out of the labor force because they can't find work. They don't want to find work.
Yeah.
One of the offsets of this whole stimulus program was we increased unemployment benefits. So if you're not working, you're getting your regular unemployment benefit plus another $300 a week. So imagine that I was, before working at McDonald's or at Sonic and, making minimum wage or maybe $10 an hour. I'm getting more now to stay at home than I am actually going to work. So this has been an interesting thing. McDonald's is trying to pay people $50 to show up for an interview because they want to hire people, but nobody wants the job. Wow. Why would I? I get paid more to stay at home. Sonic had a great sign out the other day saying, we're now providing stimulus payments twice a week. Apply inside, right? People don't want the job because I get paid more at home. This is the negative effect of these benefits. But here's the thing that people miss about the employment and the population growth in the economy. The population continues to grow every year. We are not employing, and this goes back to that comment earlier about 2% growth rate. We're not employing enough people to keep up even with population growth. There is about 16 million people in the economy that are simply missing from the rolls. And this is because they are no longer counted as part of the labor force participation rate. So, effectively, the Fed could get full unemployment according to their measure simply by enough people falling out of the labor force participation rate that they just don't get counted anymore. Absolutely. But if you take a look at that labor force participation rates, it has been stair-stepping down since 1990. That was the last time we peaked in population. And that's been stair-stepping down. We hit a new low after the financial crisis of the labor force participation rate. It ticked up a little bit, fell to a new low now in the COVID crisis. That will now set a new lower trend of population growth as we go forward. And people go, well, that was because of all the boomers retiring. They're not retiring. They can't afford to. We've got more boomers working in the market because they cannot afford to retire. 80% of the population is living paycheck to paycheck. They don't have $500 in the bank. They're not retiring.
Yeah, absolutely. I think that is again, that's the subterfuge that they always use in order to try to get, it's like the money velocity trick, is that in order to not talk about the labor participation rate, they say, well, it's people that have decided to get out of the labor force. Yeah,
Right.
absolutely, like I would.
Exactly. By the way, if you work 3 part-time jobs, you drive an Uber, a Lyft, and work at Sonic, you're no longer counted as part of the labor force.
Yeah, I know. So that's those are important factors when we come to the issue of, this is a service economy. We're talking about an economy that requires the services sector to not just go back to pre-COVID-19 levels, but to go back to the boom time that happened between 2017 2018.
Right.
What are the odds of that service sector recovering to that level, considering that there might be also a change in the way that people make their consumption decisions?
Yeah, it depends on how we kind of classify the service sector away. I've been wrestling with this thought a bit lately, because if I think about the fact that we're now have more people working at home, and you kind of hit on this with their consumption decision, my consumption decisions change. Sure. So in other words, maybe I'm not eating out as much as I was, but now I'm having more goods delivered to my house, a service, right?
Yeah.
So I think there's a potential we could see the service sector recover to a large degree, but it'll be a different service type economy than it was before if we continue to allow more and more people to work from home. And there's certainly a demand for that. There's more and more people that like that. Poll after poll has come out, like 60% of people want to keep working at home. I understand it. It's convenient, it's easy, etc. But it's going to definitely change consumptive habits in the economy. But there's one other factor to this that I think is important. We talk about the 60s and the 70s in the U.S. economy. You say, man, that's the greatest generation. They had wage growth of 8%, economic growth was 8%, savings rate was 8%. We were a manufacturing society. We manufactured everything. This was post-World War II. We had bombed out everybody in Europe, Germany, Britain, everybody. They were completely bombed out. We were manufacturing everything to rebuild those countries. But manufacturing has a very high multiplier effect in the economy. Every dollar you spend on manufacturing produces $5 and $6 of return in the overall economy. Services have a very low multiplier effect. In other words, I hire an Uber driver, that's great. I pay him, he buys gas. That's about it. It doesn't require a lot of commodity input, et cetera, so forth and so on. So one thing that I think people have to really get their head around in terms of this service versus manufacturing sector is that we're becoming more of a service society. We're manufacturing much less, and that's going to eventually deteriorate economic growth. And again, we've seen this back to these lower levels simply because of that multiplier effect in the economy.
Moving into who's building stuff for the world, one of the things that is also keeping people very optimistic is probably naive view that the Biden administration is going to be extremely open to relationships with China and ending all the trade wars, etc. So far, obviously, all of the tariffs are there, all of the sanctions are there, nothing has changed. But what's your take on that? Because something definitely might be happening on that front.
I do think that, it's interesting. I argued a lot against the trade war that President Trump initiated with China. And a lot of what I said came true, is that, it's great that you want to do this. I think we want fair trade and those type of things. But ultimately, at the end of the day, you have to be willing to change consumptive habits, right? And so if the average American goes look at their house and what they buy every day, a lot of that stuff is manufactured in China. And we're not willing to pay higher prices. There's a kind of the sense that we need to manufacture American. Great. No problem. I'm all for that. But your $500 television will now be $5,000 because you have to pay labor costs, taxes, healthcare benefits, 401k benefits, all the other stuff that U.S. companies have to pay that China doesn't. has to get factored into the price of that manufactured good. When Trump first became president, this is a great example of this. Carrier Industries, he was at that point when he just got elected, he was talking about wanting to move companies back to America. Carrier Industries, who manufactures air conditioning units, moved their plant from Mexico back to Illinois. And he got interviewed, and during the interview, nobody really listened to it. Trump was like, "This is great. We're moving jobs back to America." They asked him, they said, "Mr. Hayes, why are you doing this?" He says, "Well, we're doing this because our parent company, United Technologies, has a lot of government contracts. So we want to make sure we stay in favor with the government. But in reality, the jobs that we have in Mexico, they're $5 an hour jobs. The workers show up every day, 6 days a week. They work, they don't ask for vacation. They don't ask for time off. They don't want healthcare benefits. They just want a job. And they're very dedicated to doing their work. So we can produce at a much lower cost and then import it into the US and sell it at a lower cost and remain competitive."
Yeah.
The only reason, now this was the kicker. The only reason we're moving those jobs to Illinois is because we're getting a huge tax break from the state, and we will wind up automating most of those jobs. Good which point. Means, so, but that's what happens. And we think, we like this idea of build American, all this, but we're not willing to pay the cost.
Yeah, nobody is.
Exactly. And we also have to remain competitive. I mean, you're making stuff in Europe, we're competing with that price. Everybody's now become global. So it's a very much a global pricing competition. And so everything has to come down to the lowest price level, which means that the only fudging room I have outside of commodity prices, because I can't change that, is my labor cost.
Yeah.
So that's why we export labor costs to the lowest cost producer.
Absolutely. Here in Europe, everybody talks all the time about rebuilding industry. And nobody talks about why industry left. And the reason why, because, we have to build industry. Okay, do you know why industry left? Industry left because of high taxes, high energy costs, high CO2 costs, which are embedded in industrial costs, and high labor costs. So what are you going to bring here? No, it becomes extremely complicated, which brings us actually to the global corporate tax, that minimum corporate tax that Yellen wants to implement. What do you think of that?
Well, let's just step back to the corporate tax increase that Biden wants to do to pay for his his spending plans here in the U.S. This goes back to the root problem. I was also talking about when Trump cut taxes. He said that we have the highest corporate tax rate in the world. It's totally unfair. Our corporations pay 28% tax. That's a higher tax than any other company pays in the world. That was totally not true, because every other country in the world has a corporate tax plus a value-added tax, which we don't have. So corporations in Europe, everywhere else, they pay a VAT tax on top of their corporate tax. So we were already paying a lower tax rate, but hey, it was a good argument, so we lowered taxes. The problem, though, comes back to now you want to raise taxes. That's fine, except now that comes back to that's an embedded cost. If I have to pay more in taxes, that means I've got to cut somewhere else, or I've got to pass that cost on to consumers. If I can't pass that cost on to consumers, then I've got to eat it. And that means I'm going to have to transport some other cost somewhere else, which will probably be labor, since that's my other highest input cost. So now imagine stretching this out to a global tax. And now who's going to actually do this? It'll be Europe and it'll be the US. So great, we'll all jump on board. We'll tax each other to death, and everybody else will move all their business to India, to China, to Russia, to Africa, to Brazil, South America, wherever they can get the lowest cost of labor and bypass that tax or offset that tax to some degree. So the idea of these politicians, it all sounds great to the base. It sounds great to the little guy. And this is the one thing that people miss, right? We're all about the little guy, right? We're worried about the guy in poverty, right? We're going to lift these people out of poverty. Let's go tax those rich people. Let's go tax those corporations. Sounds great. Perfect. Rich people make up about 80% of your job growth in the US. Corporations are people that hire everybody. So when you when you tax them more, which is fine, I'm not arguing the point. However, that tax is going to get passed through as higher costs. Who winds up paying for that the most are those in poverty.
Absolutely, absolutely. Well, we know it very well, and the other thing is this: just the idea that they can believe that anything is going to be global, a global tax. What the hell are you talking about? There's always going to be not one, because again, they say, well, maybe one country doesn't adhere to our principle. No, not one. We're talking 70, 80, 90, no problem whatsoever. The other
the countries that want the work, they're not going to go along with it.
Absolutely. And the other thing is the idea that that you put a minimum corporate tax that is going to generate the level of revenues that they estimated. I saw this. Right. I saw a tweet from somebody that said, "Oh, the good thing about the Biden infrastructure plan is that it's revenue neutral." And I said, "What the hell where did you bring revenue neutral anywhere?" The estimates are science fiction, and even if you believe them, you still have the other $1.5 trillion of excess deficit to think about.
It's worse than that. This is the beautiful thing about this whole corporate tax increase, right? So he's going to spend $2.2 trillion on this infrastructure plan today that will not pay for itself over time. And the corporate tax revenue will generate $2 trillion in taxes over 15 years.
Do the NPV.
So it is not only not revenue neutral, it is actually a revenue deficit, because the recovery time of the revenue is 5 years longer than the spend program of the actual. I mean, you can't make this stuff up except if you're in Washington, right?
Exactly, where the concept of net present value is in existence. It's been a pleasure to talk with you, and all of the details to follow you will be on the details of the video. So please make sure that you follow Lance. Thank you so much for your time, and keep defending freedom. Thank you very much.
Thank you. Bye.
Bye-bye. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.